Hello everyone. Today I would like to talk about the very long end of the US yield curve. The current market conditions with super low yields clearly favor issuers. This explains why US investment-grade companies issued more than $290 billion this year on maturities of 30 years or more, and this is more than the double compared to last year. And also the average maturity of new issues moved to almost 13 years, which is more than a year increase compared to 2019. So why are investors taking this duration risk? Hunt for yield obviously is back because with rates coming to zero, investors move further on the curve to get additional yield. But doing so also means taking more risk and becoming more vulnerable to yield movements. And as we know, the longer the duration, the bigger the sensitivity. The US investment grade index performance in August is a good illustration. The index lost 1.4%, and this loss is mainly due to the increase in government yields that hit the longer maturities. And it is very visible when diving into the index segments, because the 1 to 5 year maturity segment had a positive performance, plus 0.24, but the 25-year and above segment lost 4.6%. And still this doesn't scare investors, and it creates a huge opportunity for issuers. For example, AT&T, one of the biggest corporate issuers, successfully exchanged $15 billion bonds maturing in 2031 and 58 into bonds maturing in 2053 and 2059. And previously, the group had issued $11 billion in July with more than $2 billion in a 31.5-year maturity. So the impact on the investment grade duration is quite significant because it moved from 7.8 years to 8.7 years over the first 8 months of this year. So what conclusions does this bring? First, even though they are higher, long maturity yields are low in absolute terms. And second, the new bonds pay lower coupons, and this combination, small coupon, long maturity, increases the price volatility. And we just got a good example of this volatility with the recent curve steepening when the Fed announced it would be more tolerant with inflation. So this should be a trigger to become more cautious. And in other words, markets beyond credit risk will need to pay more attention to the duration risk. Thank you.